There is a number sitting on the desk of every major sovereign treasury right now that the public has never been shown. It is not a price. It is a threshold. The threshold, not a forecast. It is a threshold, the level at which the dollar's old plumbing stops being able to carry the weight of what's about to flow through it. And the people who built that plumbing already know they are going to need new pipes. 3 weeks ago, something quiet happened in the settlement layer of the global financial system. No headline carried it. No anchor reported it. But if you were watching the right ledgers, the ones institutions watch when they're deciding where the next decade of capital is going to live, you would have seen the signature of a transition that does not get reversed. The reason you weren't told is not because it was hidden.
It is because it does not translate into the language retail uses to read markets. It speaks in basis points, in escrow cycles, in cross-border corridor volumes, in regulatory filings written to be ignored. And inside that language, a sentence has been forming for months. A sentence the architects of the new system have already finished writing, even though the rest of the market is still trying to read the first word. What I'm about to walk you through is not on CNBC. It is not on the front page of Bloomberg. It is not in the Twitter timeline of the influencers screaming about candles. It lives one floor beneath all of that, in the room where the actual decisions get made. And by the end of this briefing, you will understand why every red candle you've watched this quarter has been a feature of the design, not a failure of it. Make sure to like and subscribe and drop a comment below with your opinion on XRP. And watch until the end, because the final minutes reveal why July 13th could change everything. Welcome back. I am the calm analyst. We don't trade noise here. We decode structure. Today, we pull back the curtain on the mechanism that is quietly converting the world's largest debt market into the foundation layer for tokenized settlement. And we examine why XRP is positioned exactly where the architects intended it to be. None of what follows is financial advice. It is a structural briefing. Let's go under the surface. Let's start with the hard truth. 97% of people in this market are staring at the wrong instrument. They are watching the price chart of XRP and asking why it isn't moving. That is the equivalent of standing on a beach during low tide and concluding the ocean has disappeared. The water hasn't gone anywhere. It is being pulled by something larger than the shoreline you're standing on. To understand what is actually happening, you have to understand a concept the institutional desks call settlement displacement. This is the quiet process by which the rails that move global money are being swapped underneath active transactions, while the surface of the market continues to look unchanged. Retail investors believe a financial revolution looks like a rocket. Institutions know it looks like a renovation, done at night, in empty buildings, while the tenants are asleep. Here is what most people don't realize. The Nostro Vostro system, the network of pre-funded correspondent banking accounts that has held global liquidity hostage for over 5 decades, has roughly $27 trillion trapped inside it at any given moment. That money is not productive. It is not earning. It is sitting in foreign jurisdictions as collateral for the possibility that a transaction might need to be settled. It is the financial equivalent of leaving your car running in the driveway 24 hours a day in case you might want to drive somewhere. Every major central bank, and I mean everyone, has concluded that this system cannot survive the next decade. Not because they want it to fail, but because the math has become impossible. Cross-border payment volume is projected to exceed $250 trillion annually by 2030. The pre-funding model breaks long before that. What replaces it has to do 3 things at once. It has to settle in seconds. It has to be neutral, meaning no single nation can weaponize it. And it has to be liquid enough to absorb sovereign-scale flows without slippage. There are exactly 2 assets in the world that meet all 3 criteria simultaneously, and only one of them was built from inception specifically for this purpose. This is not a story about a coin going up. This is a story about an obsolete system being replaced. and the replacement asset being held today at prices that reflect the old system's confusion, not the new system's reality. Let's do the math the retail crowd refuses to do. The global FX market moves approximately $7.5 trillion every single day. The cross-border payments market processes around $150 trillion per year. The derivatives market, the largest financial market on Earth, sits at roughly $1.2 quadrillion in notional exposure. These are not abstractions. These are the rivers that the new settlement layer is being engineered to carry. Now consider the supply side. XRP has a fixed cap of 100 billion tokens. Of that, roughly 55 to 57 billion are circulating. The rest sits in escrow, released 1 billion at a time each month, with the vast majority immediately relocked. Lost wallets, dormant addresses, and institutional cold storage have already removed billions more from any realistic float calculation. Here is the calculation that changes everything. If the XRP ledger captures even 0.5% of annual cross-border payment volume, not derivatives, not FX, just cross-border payments, that is $750 billion of throughput. Every dollar of throughput requires a corresponding amount of XRP to act as the bridge asset. The token doesn't disappear after each transaction, but the working liquidity needed to support that volume is mathematically substantial. Think about what that does to a fixed supply. You have a finite pool of liquid tokens, somewhere between 30 and 40 billion when you strip out escrow, lost wallets, and institutional lockups, being asked to bridge an expanding share of multi-trillion-dollar flows. The price isn't a prediction in this scenario. It is a requirement. The system needs the token to be priced at a level where a single unit can carry significant value, because otherwise the throughput math breaks down. Lower price means more tokens needed per transaction, which means more slippage, which means the system becomes less efficient at the exact moment it is being asked to do more. This is not a moonboy fantasy. It is a design constraint. If you have a problem with the arithmetic, you don't have a problem with me. You have a problem with the difference between a fixed supply asset and an expanding utility curve. Those two lines have only ever resolved in one direction in the entire history of financial markets. While the retail audience has been arguing about candles, the institutional signal has been deafening for anyone willing to look at it without emotion. Ripple's acquisition of Hidden Road was not a press release. It was a declaration. Hidden Road clears trillions of dollars annually for some of the largest institutional traders on Earth. You do not buy a prime brokerage of that scale unless you are preparing to route institutional volume through infrastructure you control. You do not make that purchase to wait around. You make it to deploy. The G Treasury acquisition compounds the signal. Treasury management is the deepest, most boring, and most consequential layer of corporate finance. It is where Fortune 500 companies decide which rails their billions sit on overnight. Acquiring G Treasury is acquiring a direct interface into that decision-making process. Look at the regulatory chessboard. The Digital Asset Clarity Act has moved through the necessary committee structures and is positioned for resolution within the current legislative window. Japan's FSA has already greenlit XRP-based ETF products. Spot exchange-traded products in multiple jurisdictions have logged consecutive weeks of net inflows, even through periods of broader market drawdown. BlackRock, Fidelity, Franklin Templeton. These are not retail brand names. They are the firms that custody the retirement of the developed world. They do not move into a structure unless the legal certainty has been delivered to them in writing. Ask yourself a brutal question. Does a firm managing $11 trillion in assets enter a market that they believe carries unresolved legal exposure? Does a sovereign-aligned custodian sign infrastructure agreements based on hope? They do not. They position, and the only reason they position before the public catalyst is because they have been shown, behind closed doors, that the catalyst is no longer in question. This isn't retail FOMO. This is the silent reallocation of the largest pools of capital on Earth into the rails that will carry the next financial epoch. The retail crowd is providing the exit liquidity of the confused to fund the entry of the informed. We are no longer in the era of speculation about whether the catalysts will arrive. We are in the era of counting them down. The Clarity Act resolution window closes within the current congressional calendar. Once that legislation crosses the line, the legal risk premium that has held institutional allocation in check for nearly a decade evaporates in a single afternoon. Every fund manager with a fiduciary mandate that prevented digital asset exposure under regulatory ambiguity will be free to allocate the next morning. That is not a slow trickle. That is a gate opening. The next quarterly cycle brings a sequence of ETF-related deadlines across multiple jurisdictions. Japan's framework is operational. European regulators are watching the United States closely, ready to mirror. The Middle Eastern Sovereign Wealth Corridor, the UAE in particular, has already established the technical infrastructure for digital settlement. On the macro side, the Federal Reserve's policy posture is tilting toward looser financial conditions. A dovish chair, productivity-driven disinflation, and an explicit administrative interest in expanding stablecoin frameworks as a deficit financing mechanism are all converging in the same direction. When the policy, the regulation, and the institutional infrastructure align, the wait-and-see capital becomes all-in capital. There is no third option. The fuse is not theoretical. It is lit. The only question is which catalyst arrives first, and by the time you can identify it on a news ticker, the position has already been taken by people who didn't need the news ticker to act. We are moving from an era of abundance into an era of scarcity, and most participants will not recognize the transition until they are already on the wrong side of it. Exchange reserves of XRP are sitting at multi-year lows. The tokens that are leaving exchanges are not coming back to be sold for a 10% profit. They are entering institutional cold storage, multi-signature custody arrangements, and corporate treasury vaults. Once a token crosses that threshold, it is functionally removed from the float. The supply that the price is being discovered against is shrinking, quietly, every single day. There is a moment that arrives in every asset that becomes structurally important to the global financial system. The moment when retail can no longer accumulate whole units. The moment when the market begins to be priced in fractions, drops, in the case of XRP, where 1 million drops equal 1 token. That moment is not a theoretical event. It is the natural consequence of finite supply meeting expanding demand under regulatory legitimacy. The institutions have spent the last several years engineering precisely the conditions that would shake out the impatient. The drawdowns, the FUD cycles, the regulatory uncertainty that turned out to be temporary, all of it functioned as a filter. A filter that separated the holders who understood the structure from the traders who were watching the candles. The filter is closing. The window during which this asset can be acquired at retail-friendly prices is measured in months, not years. The door is closing, not loudly, not with a warning bell. It is closing the way institutional doors always close. Silently, while the people on the other side are still arguing about whether it was ever open. I know what the last several months have felt like. I know the red candles wear on conviction. I know that watching an asset you understand sit in a range while the rest of the market chases narratives is a specific kind of psychological exhaustion that very few people outside this market understand. But I want you to distinguish, carefully, between noise and signal. The noise is the price action. The signal is the infrastructure. The noise is the headline. The signal is the acquisition. The noise is the influencer commentary. The signal is the legislative calendar. The noise changes every 15 minutes. The signal has been moving in one direction without interruption for years. Being early feels exactly like being wrong, right up until the moment the math catches up with the price. And the math always catches up. It has never failed to catch up. Not in a single asset class. In a single decade, in the entire history of financial markets, the only variable is whether you are still positioned when it does. The question is not whether the price recovers. The question is who will still be holding when the levels we are looking at today become the floor that the next cycle is built on top of. The institutions know who they want that to be. They have made it as uncomfortable as possible for that group to remain. The people who are still standing at this point in the cycle are the people the system was always going to reward. Make sure to like and subscribe and drop a comment below with your opinion on XRP. And watch until the end, because the final minutes reveal why July 13th could change everything. Price is a distraction. Structure is the reality. The candles are noise. The architecture is signal. Everything we covered today, the settlement displacement, the institutional positioning, the regulatory convergence, the supply scarcity, the macro liquidity tailwind, none of it is speculation. It is observable. It is documented. It is moving on a timeline that does not require your belief to proceed. The only question that matters at this point in the cycle is not what XRP does next. It is whether you understood what was happening early enough to be on the correct side of the renovation when the tenants finally wake up. If you made it to the end of this briefing, drop the word structure in the comments. I want to see who is actually paying attention to the architecture and not the noise. If this kind of analysis matters to you, subscribe. This channel exists for the people who would rather be informed than entertained. In a market fueled by emotion and reaction, we move on data and composure. Stay patient. Stay rational. Stay positioned. The math doesn't lie, and the system is almost complete. I am the calm analyst. I'll see you in the next briefing.